Well, the CoreLogic index is up another 1.1% over August, and we've seen very similar results over the previous 2 months as well. So you can annualise that out, and we're still looking at very strong capital gains in the Australian housing market. But of course, from region to region, we are seeing very different results. Outside the capital cities, markets are virtually flat. With around the capital cities, we're still seeing Sydney and Melbourne leading the charge of very strong growth. At the other end of the spectrum, we're seeing Perth, Darwin, still relatively weak markets, but potentially some acceleration in markets like Hobart and Canberra, where we have now seen the annual rate of growth is approaching 7% in Hobart and a little bit higher than that in Canberra. Mining towns generally peaked around 2012 when commodity prices peaked, and they've been in a decline, a pretty severe decline since that time. So we have seen value falls in areas like the Bowen Basin in Queensland, which is coal, of more than 50%. The Pilbara, same sort of thing, right? A bit more iron ore related. I think we're starting to see those marketplaces approaching the bottom of this cycle. It's very difficult to imagine values could fall even lower than what they are. They're already below replacement cost. So, and generally, we're also seeing some flight to quality in the sense that the newly developed housing in those markets are now attracting rental tenants, and occupancy rates are not too bad. Is there anything ahead in the future? That's the big question here. I don't know, and it's really dependent on probably commodity prices showing some further improvement, but more importantly, miners really starting to once again ramp up their infrastructure development. No signs of that happening just yet. So talking about interest rates first, I wouldn't be surprised if we see another rate cut in November. That's going to be on the back of the inflation numbers. If they do come out with another very low print, say 1% headline inflation year on year, that's a pretty good reason for another rate cut. The Aussie dollar, the rate cuts don't seem to be bringing the Aussie dollar down like everybody hopes it would. I think to reduce the Aussie dollar, we're going to need to start to see US rates starting to rise. A lot more talk about that now, which may take some pressure off the RBA to actually cut rates. It's a very fine line they're walking at the moment, trying to promote the economy and stimulate the economy without overstimulating the housing market. So we're already seeing interest rates are creating demand. We are seeing a recent bounce back in the housing finance numbers for investors and for owner occupiers. So there is some risk that lower rates will continue to add some further fuel to the fire in Sydney and Melbourne. I think other markets like Perth and Darwin and Brisbane could probably benefit from lower interest rates, and really do need some stimulation in those regions.